Welcome to The Explainer. Have you ever bought something online from another country? That single click actually sets off a chain reaction that shapes the entire global economy. Today, we're going to follow the money.
On the surface, it seems pretty simple, right? You click buy and a package shows up. But behind the scenes, every single one of those international purchases is a two-way street, and understanding that is totally fundamental to how the global financial system works.
Okay, so here's the big idea, the key that really unlocks everything else. Every international transaction is actually two trades. You've got goods flowing in one direction and a financial asset, your money, flowing in the other. Once you see that, I promise, the rest of global economics starts to make a lot more sense.
All right, so let's scale this up. What happens when we stop thinking about just your one purchase and start thinking about all the transactions of an entire country? Well, we need a way to measure these two different flows.
First up, to measure the flow of goods and services, economists use a simple calculation called net exports, or NX for short. If a country sells more than it buys, its net exports are positive. That's what we call a trade surplus. If it buys more than it sells, net exports are negative, and that's a trade deficit.
Second, to measure the flow of financial assets, things like stocks, bonds, or just currency, we use something called net capital outflow, or NCO. It basically just tracks whether a country's own residents are buying more foreign assets or if foreigners are buying more of that country's assets.
And here it is, the absolute core principle of international macroeconomics. Net exports must always equal net capital outflow. NX equals NCO. This isn't just a theory or a coincidence. They are literally two sides of the exact same transaction, so they have to balance out.
Now, I know that might sound a little abstract, so let's walk through a simple example to see how this works in practice. It's not magic, it's just accounting. Every single dollar has to go somewhere.
So the website sale is an export, which increases U.S. net exports. Simple enough. But at the exact same time, the American designer is now holding euros. That's a foreign asset. This increases the U.S. net capital outflow by the exact same amount. You see? Both sides of the equation move together perfectly. And this is true for every single international transaction.
Okay, this is where it gets really interesting. That simple equation, NX equals NCO, is the bridge that connects a country's domestic economy, like how much it saves and invests at home, to its role on the entire world stage.
This relationship is incredibly powerful. It shows that a nation's total savings, all the money it doesn't spend, gets used in only two ways. It's either invested domestically in things like new factories, or it's invested abroad by buying foreign assets. That's it.
So, this all leads to two main scenarios. A country with a trade surplus is saving more than it invests at home, so it sends that extra capital abroad, and it becomes a net lender to the world. On the flip side, a country with a trade deficit is investing more than it's saving, and to fund all that extra investment, it has to borrow from the rest of the world.
So what determines all these flows of goods and capital? It pretty much all comes down to a price. The price of one currency in terms of another, which we call the exchange rate.
But there are actually two types. The nominal rate is the one you see on the news, how many yen you can get for $1. But the one that really matters for trade is the real exchange rate. It answers the question, if I trade in my American car, how many Japanese cars can I get for it? It's all about purchasing power. And we can see this in action using a simple Big Mac. When you factor in the prices and the nominal exchange rate, it turns out one US Big Mac is worth about 1.16 Japanese Big Macs. That number, the real exchange rate, is what ultimately tells us whether foreign goods are a bargain or not.
This brings us to the big, controversial question you always hear about in the news, especially around election years. To answer this, we have to go back to our trusty equation. Saving equals investment plus net capital outflow. A trade deficit means NCO is negative, which just means saving is less than investment. But that doesn't tell us why. Is saving too low, or is investment really, really high? The reason makes all the difference.
If you look at the U.S. trade deficit over time, it reveals completely different stories. In the 80s, the deficit was driven by falling savings, but in the 90s, it grew because of a massive investment boom during the dot-com era as foreigners rushed to pour money into the U.S. economy. Same symptom, totally different causes.
The best way to think about it is this. Going into debt to pay for a college degree that will boost your future income is very different from going into debt for a lavish vacation.
One is a productive investment. The other is just consumption.
So, the verdict is that a trade deficit is a symptom, not the disease itself. A deficit fueled by an investment boom can be a sign of a strong, attractive economy. But a deficit that's caused by a collapse in saving could be a really serious red flag. So, instead of just asking whether the deficit is big or small, the truly insightful question is this: what is causing it? Is our country borrowing from the world because we are failing to save for our future? Or are we borrowing because our economy is filled with such attractive investment opportunities? That question makes all the difference.